Hi, I'm Hans Holmen, Executive Director of the Collar Institute of Private Equity at the London Business School. I'm here with Mounir Guen at our 2011 Symposium. We just had a panel on emerging markets, private equity investment. I was just wondering, Moose, what are your perspectives on what the keys are to successfully investing in emerging markets at the moment?
In this current market, there's probably about $90 billion that's looking for a home in the emerging markets. And there isn't enough general partners in the marketplace to absorb that type of capital, or which would meet the type of requirements that you're asking in your question. And the investors are very sensitive to having experience, so they would like to have Fund 3 or plus, so someone that's been around for 10 years plus in terms of private equity. They want to have low loss ratios because they're very sensitive to the fiduciary and conscious responsibility of the general partner to the capital that they're using to make the investments. And they're also looking for a consistent return. Interestingly enough, 10 years ago, if you asked me the question, I would tell you they'd be looking for a 4 times gross fund performance. They're probably down around 2.5 at this time, which is equivalent to what it is in Europe and the United States. Okay. Which is actually not that easy to generate in the current global market environment. Most of the very high-performing European, US are somewhere between 2 to 2.5, to be very frank. And then within that concept, they're looking for local knowledge, local understanding, who not to work with, so that they could focus who to work with. And then the most important aspect of the process is transparency. Because this issue of governance, strategy, execution, focus, track record, performance is all very contingent on being able to verify everything. And so those are really the criteria by which the investors are making their selection. Absolutely. And they cannot find very many that actually meet all of those selection points. So some of the larger investors have started founding their own groups, most recently in India by one of the large global pension plans, where there was an individual who had that type of history and record that I just alluded to in the points that I made. And this one investor is the bulk of that fund's support. And in Korea, that's been the case. So it's an interesting market because you have those two types of funding backing at this time.
Yeah. And are investors still looking at the BRIC markets, or are they going beyond the BRICs these days?
Well, it all depends on how much money they have to deploy. Because if you're looking to put to work $500, $600 million per year, the smaller markets don't have enough of a size. I mean, you're looking at funds that are 250, 300 million in size. Most pensions or most institutional investors have a criteria of 10% holdings, right? And that's a 25 million, 30 million ticket. You're trying to put to work a couple of billion. That's not going to impact the performance of the portfolio. Mm-hmm. So there's a tilt that occurs there. If, on the other hand, it's a smaller type investor, and they are looking for more the high or growth areas of the world economies, where from my 23 years in the industry, I haven't seen quite a big correlation between growth and PE performance. Yeah. It's been mostly competence of the general partner that's caused the performance. Yeah. And what I have found from the samples of hundreds of funds that I interview every year is that there's a lot of volatility across the board. Absolutely. So you have to select properly. So for us, it's very much a bottom up.
Well, it sounds like a challenging environment, but the rewards are there for those who are successful.
Oh, very much so.
Thank you very much for your time, Moose.
You're welcome. Thank you. Thanks.